I'm Jarrad Brown, Australian expat financial planner based here in Singapore. Welcome to my video series where we tackle the tough personal finance questions asked by Australian expats. Today, I'm going to be walking through some of the most damaging financial decisions that retirees can make. Now, these are particularly focused on periods of volatility. Obviously, 2020 has certainly been that. So I want to cover off some of the mistakes that you can avoid making in future. So let's get into it. Now, the first common mistake that we see retirees in particular making when we get a market downturn is switching all of their investments into cash. Now, this typically happens when we get a period of great volatility. So think back to end of March, April of this year. We saw global equity markets down 30, 40, 50%. And particularly with our clients, we know because we were having lots of conversations and our clients were asking the question, should we go to cash? And the answer 99 times out of 100 is always no. We want to be rebalancing over time, taking some chips off the table, adding to if we think things are cheap, but never the wild swings of all in or all out of the market. Now, what you'll see in the following chart is some of the damage that can be done by switching all of your investments to cash, because it's very hard, I would argue impossible, to know exactly when to get back into the market, and often we'll miss some of the bounce. And this should be reflected in the chart here. The second most common mistake that we see retirees making is when they've gone to all cash when we see a period of volatility. They see the markets bounce 15, 20, 30, 40% back up to previous highs and then worry that they've missed that upside. So what do? We try to double down. We try to recoup those gains that we've missed out on because we went to cash. Now, this often means that we're taking on riskier bets, we're buying more speculative shares, and we're taking on far more risk than we should be. So again, it's important to rebalance, maintain an appropriate asset allocation, and avoid doubling down. The third common mistake that we see people making, particularly retirees, is seeking advice from family, from neighbours, from the taxi driver. That's often a good sign that you know a crash is coming when you're getting stock tips from your Grab or Gojek or taxi driver. As always, seek professional advice from qualified people who can objectively explore your situation. While family members might have the best of intentions, if they're not qualified financial professionals, it's very difficult for them to offer you sound advice. The fourth and most common mistake, or most common thing that gets ignored, is to review your timeframes on a regular basis. Now, by this I mean as we get older, as we get closer and closer to retirement, we may want to be stepping down the level of risk that we take with our investments. This may mean reducing our exposure to growth assets, being property and shares, and increasing cash, term deposits, government, corporate bonds to reduce the volatility of our investments. As we get closer and closer to retirement, it often means that we've got less time to ride out volatility. So if we're 2 or 3 years away from retirement and we get a downturn such as we saw earlier in 2020, then this means that the volatility is not going to be as destructive for us. So I hope that makes sense. I hope those 4 tips have helped you, have offered some insight into things to avoid. If you have made some mistakes this year, then things you can hopefully avoid in future. Thank you very much for joining us. If you have anything to add or you have any questions that we haven't yet covered, fire them through. We'd love to hear from you, and maybe we can even turn them into a future video. Thank you again for tuning in, and I look forward to seeing you next time.